retirees can take money tax-free out of their IRAs. We'll be talking about how you can do that today on Friends Talk Financial Planning. Hi, I'm Bridget Sullivan Mermel, and I've got a free financial planning practice in Chicago, Illinois.
And I'm John Scherer. I run a fee-only financial planning practice in Middleton, Wisconsin. And what a great introduction, Bridget, right? That sounds like one of those headlines that you click on, right? Take money tax-free out of your IRA. And yet it's in the IRS code, right? Some of the tax law changes these last couple of years have actually allowed this. And so for the right person, of course, it doesn't fit everybody, but for the right people, it can be a really big tax savings.
Right, and it makes things a little bit easier too. So John, let's talk about how we end up implementing this with some clients. So talk me through who qualifies for this.
Well, sure. So the deal is with the new tax law changes last year is now it applies to people who are age 72 and older, right? So it's in that situation, and what those rules are is that at 72 is when you have to start taking your minimum distributions from your IRAs. So last year and the year before, it was at 70 and a half. Now it's 72. So that's the section of people is that you have an IRA and you're at age 72 or older when you have to start taking out money. Then these special rules apply. And kind of in a nutshell, what it allows you to do is to take money from your IRA, send it to a charity, and it never becomes taxable income. It's a tax-free donation, so it never shows up on your tax return at all. And
exactly.
Yeah, and so that, I mean, it's really sort of an elegant, sort of simple thing, but it only applies in certain situations for things with, we've talked before about itemizing deductions versus not itemizing, and it only applies really if or mostly applies if you're in a spot where you're not itemizing deductions.
Right.
And so, are you doing a lot of, we hadn't done a lot of these in the past before the standard deduction rules changed, but now we're doing a lot more. Are you seeing that in your practice, Bridget?
Absolutely. Yeah, definitely. It's really gotten to be a bigger planning tool for us since less people are itemizing. So we have more people just sending checks directly from their IRAs to their charities, their 501(c)(3) charities. And what we have a custodian relationship with Schwab, and so Schwab will issue the people with IRAs a checkbook, so they can actually just send checks. They can write a check from the Schwab account to their charity, and so that's how it makes it simpler. Is that what's happening with your people, John?
Yeah, that's about the situation. And again, I think it was 2 years ago they changed the tax law where it used to be, I don't know the number, but like most of our clients were itemizing their deductions, right? You write a check to charity, you take it off a deduction on your taxes. And now I think nationwide, it's something like 90% of people are not itemizing. So then suddenly those checks I write out of my regular personal checking account to charity, to the church and whatever, those are not, they're technically deductible, but they don't give me any benefit. Right. And so when I'm in that spot, right, as a client, somebody who's like, okay, I'm 72 now, I'm forced to take money out of my IRA anyway. And when I write a check out of my checkbook, my personal checkbook, I don't get a deduction. Well, shoot, if I can do what you're talking about, Bridget, right? I take money, I write the check right out of my IRA and it goes to charity. And because it never becomes taxable, it's the same as getting a tax deduction for it. It's really an elegant solution, and it just encompasses so many more people at that age, right? You get up into your 70s, you got to start thinking about this, because you might sort of unwittingly, if you're not looking closely at your taxes, hey, what was deductible 5 years ago suddenly is not giving you any benefit, but you've got this window that lets you take money out tax-free for charitable things. It's like the perfect storm for people that fit in that situation.
Right, and another reason why a lot of older people aren't itemizing as much as they used to is because they have their mortgage paid off, and since the standard deduction was raised, they don't have as many itemized deductions anyway, and so they don't meet that threshold, and so they're not itemizing. They still get a good standard deduction, but they're not able to take advantage of a direct tax break for charitable contributions like they used to be able to.
You reminded me of client situation where these folks were giving about $10,000 a year is kind of what they normally give to charity. And in the years past, that would go right onto their Schedule A, their itemized deductions. They'd turn all those slips into their tax preparer, right? And they'd write off, and they had like, 2 pages of a one, loose leaf paper, filled out with all their deductions, everything documented. And they take a deduction, they get like, $2,000, $2,500 savings each year for making those donations to charity. Good deal. Tax law changed, right? Where now their standard deduction is so high that they don't itemize anymore. So they're getting the standard whether they give money to charity or not. And so then those deductions get lost. They're still giving 10,000 because it's the right thing to do. That's what their priorities are. And there's no tax benefit. Now when they turn 70 and a half and we're able to do it, now it's age 72, now they do it right from their IRA, and they effectively save that $2,000 to $2,500 tax break, right? It's literally, a couple $1,000 in their pocket each year just by knowing that this trick exists, right? Like this
Right.
place exists where and I can use this clause in order to do what I'm already doing and take a tax deduction. But if you don't know about it, if you don't ask your financial planner about it, then you never have a chance to take advantage of them. It's real dollars in people's pockets.
Right, and a lot of people are eligible for this and they might not know about it. So that's
right.
One of the reasons why we're doing this, is because we want to make sure that we get the word out so that people who are retired that are taking required minimum distributions understand this. One more point I just wanted to make, John, that I don't know if we've covered enough, is that these, when you make they're called, what is that jargon? QCD, Qualified Charitable
right.
Distribution. So when you make a Qualified Charitable Distribution, it counts as your required minimum distribution.
Right.
So let's assume that let's just say that your required minimum distribution is $20,000, and you don't actually need that $20,000 to live on. You're only taking that out because it's required. Okay. So then if you give away through through your Schwab checkbook, your $10,000, that counts towards your $20,000 required minimum distribution. So that's another reason why we really like these QCD, Qualified Charitable Distributions.
Right, you got to get the jargon place.
Because they count as the RMD, the required minimum.
If you have RMDs from your IRA, you need to use a QCD, right? What else?
Exactly.
Right? FYI, right? That's all we need.
Yeah, right, exactly. So we'll get you jargoned up.
That's right. That's right. The one other thing, when you were bringing up that it does replace those minimum distributions, the other thing is for people who are itemizing their deductions, meaning they actually list out all of their donations. Sometimes this charitable distribution from the IRA makes sense. Sometimes it doesn't. So you have to look at it more closely. But if you're taking the standard deduction, it's like a slam dunk, right?
That's absolutely right.
And when we talk about
this kind of depends on how things are set up. If you are itemizing, it's just a more complicated.
It's something to ask and to check on. And as I think about for viewers, like, listen, if you're over 72, or if you're 72 this year, this is something that you need to be talking about or thinking about and looking at. And for our younger viewers also, I look at these things and go, geez, does my mom and dad, are they doing these things, right? Like it's even if it doesn't apply to you directly, you go, hey, listen, this could be, we're talking, again, real dollars in people's pockets. So taking a look at that as you think about giving to charity, taking money out of your IRAs, and especially if you have those minimum distributions, this could be a place that's really cash in pocket dollar savings.
Right. So let's talk about our action items, John. What's the first thing that you recommend people do if they're interested in this?
Well, what people need to do is take a look at your tax return. Are you taking the standard deduction, or are you itemizing? If you're taking the standard and you want to give money to charity, right, and you're over 72, so if you fit those criteria, this is something that you need to be talking about and thinking about as you make your distribution. So that's the big thing. And I think, as I just said, like, hey, even if I'm younger in that spot, but I've got parents or relatives or friends, like, they should be thinking about this stuff, because usually we don't see the tax folks or even the investment folks that aren't doing holistic financial planning. They're not bringing this up to people. So those, I guess, are my three takeaways. Yeah.
Their motivation is to keep your money,
right?
Because that's how they make money. It's not to help you figure out how to give away at the best tax with paying the least amount of tax.
That's right. So anything else that you have as far as action items for folks, Bridget?
The biggest thing is figure out with your wherever your IRA is housed, you want to figure out how to facilitate actually making these contributions. Like I said, Schwab, I think it makes it really easy. But I'm sure that the other large brokerage houses do as well. So, but you need to ask ahead of time to get that checkbook or whatever, so that you could get it done by the end of the year.
Do a little preparation. That's great. Well, if you are interested after hearing this in the type of work that Bridget and I do, we're both members of the Alliance of Comprehensive Planners, which is a group of fee-only, tax-focused advisors with advisors across the country. You can take a look online for that, and the website I believe is acplanners.org, Alliance of Comprehensive Planners. And look for somebody if you need some help with this or wanted some help for your parents with this. A great resource. And I think that's
one more thing we want to ask people to subscribe. So if you like our
that.
channel, hit the subscribe button. You should be able to change. If you hate notifications, that's how I am. I don't like notifications all the time. But they didn't automatically turn on. So when I subscribed to the channel, it was seamless, and I'm not getting inundated with anything I don't want.
That's great. Hit that subscribe button. Yeah, please subscribe, and until next time.